Welcome to Investment 360. In the hot seat this evening is Mark Witten from Kaizen Asset Management, and of course still with us is Wayne McCurry from Momentum Asset Management. Mark, thank you so much for joining us. Great to have you on the program. Tonight we're looking at the Strategic Opportunities Fund that you've got. You've basically got three strategies within the fund. Give us a sense in terms of what kind of exposure you'll have with this fund. Three strategies, obviously you've got a lot of leeway to play with.
Yeah, look, basically we split the fund up into a fundamental bucket, a trading bucket we call it, and an opportunities bucket. I've worked in various asset management businesses, and I've realized that certain tools work in certain markets, certain strategies work. In a strongly trending market, fundamentals work very well, whereas in a market like we're in now, which is much more liquidity and sort of emotional driven, I think technical analysis can work just as well. So essentially, we continuously do the fundamentals. We'll always be going to company results presentations, doing research, reading up, doing our own research, etc. And we plan our trades up front as to which companies we like, which ones we want to be long of, which commodities we like, what the hedges are, etc. And we utilize things like technical indicators, the spreads between companies, or if the underlying, like at this point in time, let me give you an example. At this point in time, a lot of the commodity counters are not reflective of spot, if you ask me. So if you look at a company like Anglo's, which derives 30% of its earnings from copper, and copper this time last year was trading at, let's say, $7,500, and now it's $8,500 to $9,000. You look at the rest of the drivers, such as iron ore, coal, diamonds, etc. They're for much, they're much higher than they were a year ago, and at the same time, Anglo's is actually rolling out more capacity. So, going forward, we expect to see an increase. The momentum in Anglo's earnings, or Amplat or Kumba, in any of these companies, is much stronger than they've reported in the past.
You took off these three strategies. Tell us about the play between and the percentage.
So look, the fundamentals are always going on. The trading bucket is a much more aggressive bucket that obviously takes advantage of severe market moves.
And what percentage of the portfolio does this? It
shifts. Generally we like to have, call it 40% of the fund in the fundamental bucket and around 40 to 50% of the fund. When I say trading, it's more of a macro bucket. I'd rather use that terminology. It's more of a macro bucket that's based more on how we see the world, in terms of what's happening globally. Because as much as South Africans like to believe that the prices are set locally, the majority of our bourse, the big counters, are set in London. And it's more important what Deutsche Bank or Goldman Sachs thinks of these companies than it is what South African companies think of them. That's just always been my viewpoint. Billy's, Old Mutual, SAB, British American, Anglo's, these prices are set in London. The rand, you can see with the market having sold off over the last few days and then recovered today, but you can see the rand blew out, and Anglo's and Billy's, our market didn't experience the same extreme sell-off. Yeah.
Mark, you said in your various pamphlets here that either commodity prices must fall 30% or shares go up 40%. I just want to know which one is going up and which one's going down. Because I agree with you totally. Either shares are undervalued or commodity prices must fall.
Personally, as I learned I actually was at law school, so they always say, pick the middle ground. So I think it'll be a combination of the two. But realistically, if I look at what is the fundamentals holding back the commodity prices, the actual share prices like Anglo's and Billy's, it's just investor sentiment, let's say, the rating they're willing to pay for the risk. When I look at the fundamentals of commodities, I don't see, China's slowing down, but they're not falling in a heap. They're slowing down to 8%, as is India. We see all the auto manufacturers out of Europe, particularly in Germany, saying they can't get production up fast enough to supply the cars that are needed in the East. You see Richemont's statement coming out saying that the affluence in the East is growing. Their sales are up 56% across the Asian countries. So in my mind, you've got this first phase of urbanization that's continuing going forward, and the demand for commodities is there. And the shocks generally are to the supply side are negative. Weather-related events, earthquakes, etc., political uncertainty. And it's also difficult to get the stuff out the ground. It takes a lot of skill, it takes a lot of capital, there's a lot of lead and lag time. So in my mind, I think commodity prices will continue to hold. And as the earnings start coming through and these companies start accumulating excess cash in their balance sheets and paying it back, the market's telling you they don't believe that commodity prices are going to hold. But Bernanke's keeping rates, he's committed to keeping rates at 0.25% for the next 2 years. So the long commodity short dollar trade is back on.
Just from my experience, what I see on this desk and the people that I speak to, I hear the same rhetoric coming through.
It's not rhetoric, it's the truth.
The truth, the views with regards to Anglo's, BHP Billiton, the resource space in particular, we just need to see a re-rating. These stocks are looking very cheap, they're offering immense value, but we're just not seeing it occur. You're saying that the prices are set internationally and this is what the big disconnect is. Is that right, Mark? What kind of scenario are you pricing in going forward here? Because we've got lots of risks on the horizon. Yes, we might have interest rates, declared to be unchanged for the next 2 years and ultra low in the US, but we could see a big shake-up globally. And if we do see a recession in the US, that could change things fundamentally. Okay,
well, I mean, starting at the back, a recession is defined as 2 quarters of negative growth. So the US is slowing down, as is Europe, but they're not going backwards. I mean, we've seen today the ECB moved its meeting 1 day back, okay? And so it's in line with the Fed's meeting, which means they're all going to be going at the end of the week through to Washington to meet with the IMF and the World Bank. You're seeing a coordination of policy now globally. You've seen the states open up their coffers to the European banks and say, we'll support you. China's going to have to back the euro because they want another currency. So in my mind, it's like, yes, there are lots of risk in the horizons, but this market is priced in a recession. When the Swiss bond yield went below 1%, you got to start thinking, well, the last time we were at these levels in 2008, what were commodity counters trading on? Like 1824s. You had construction companies on 22 forwards. That was bubble territory. The valuations were extreme. Now you've got companies that are in better shape, more cash on their balance sheet. Anglo's is in the best shape it's probably ever been in, and yet it's trading at a 6 forward PE at worst. So in my mind, like, I think there will be lots of risk on, risk off, and that's why I was saying earlier, the fundamentals aren't playing out at the moment, as nobody's really, if you look at companies like, I went to, call it MMI Holdings results last week, and they're sitting with like 18% of assets under management in equities. That's not very aggressive, do you know what I mean? A lot of people are sitting holding back. There's a lot of cash on the sidelines. Globally, fund managers seem to be very, very bearish.
Wayne, what is your sense? When you see this established, I think, beginning of, actually 1st of July. Is this one?
1st of July last year, yeah.
Last
so
year, 1st of July last
year.
year. So what is the returns been?
As of today, we're about 25% up year to date.
I actually agree with Mark on the overall outlook. Slower growth is not a recession. What has actually happened is that in the beginning of the year, everyone thought the US was going to grow at 4%. Now it's growing at 1.5% or 1%.
But so
there's a big drop in expectations, but it's still growing. This whole European story is just politics. They have to bail the Greece government out, and they've got enough money to do it. So I think we're going to see a result of it. And in that environment, we're probably going to see reasonably robust equity markets. But equity markets, and I agree truly with Mark saying that when the last time they were collapsed, they were massively overvalued. They're not even close to the same level of valuation. But they're not cheap. They're not, it's not cheap. This is not like the all-share index at 17,000. I mean, the all-share is 31,000. Yep. I'm not saying it's going to collapse, but it's not time to jump in boots and all.
What is your benchmark on this fund?
As with most hedge funds, it's the STEFI, which is a kind of a cash benchmark, but it's a rolling high water mark. So every month you're up against your past performance plus 0.5% essentially. But our benchmark that we like to use internally is the market on a monthly basis. The top 40, we generally only trade within the top 40 as well as commodities and gilts. So we try to pace
Mark,
the market.
how do you access the fund? What platforms are you on? How do you get into the fund?
Is
it a standard unit trust?
No, it's not a unit trust. Okay. It's an in-common partnership. So there's we use Peregrine Prime as our prime brokers.
Okay.
We use IDS as the independent data verification, and if you wanted to get onto the fund, you then subscribe for units in the partnership or a position, and you put in as much as you want, or not.
Or not. Okay, and with regards to re-weighting, just looking at new strategies going forward with all this risk and noise, is it making you feel uncomfortable?
No,
what are clients saying right now about your strategies? I mean, you've got a three-pronged approach, so you kind of touch on all the important elements in the market.
Look, I mean, if our fund is volatile, in my mind, you can't get reward without taking risk. I can sit in cash, or I can sit in the majority of my fund in bonds and earn 0.5% to 8% a year, let's say. And that's not, to me, what a hedge fund is built to do. So we target between 3 and 5% up every month. So we are quite aggressive, and obviously not for everybody. Our strategy going forward is, we think gold's a bubble, so we short gold, long platinum, but we particularly like the counter. So we think Harmony is not a great company, but Amplats is a great company. So we're doing stuff like that. We're planning trades up front. We do believe interest rates are not going to be hiked locally for a while as unemployment goes up. Look, I mean, without giving away too much, we're very bullish on the BRICS, excluding the S part. So we love what's happening in India and China. Having been to China, it blows your mind what's going on there. As big as you think it is, it's bigger, and it's continuing to grow. It's a machine that it's not going to slow down anytime soon. I've also been to Germany. I look at the DAX trading at 7 times earnings, and there's companies in there like Volkswagen or BASF or Tush and Reinstyle. I mean, those are companies that are spectacular companies. They're strong companies. Trading at 7 multiples is not it's not a demanding valuation.
Yeah.
So yeah, going forward, we're very bullish.
Fantastic, Mark. We have to leave it there. Great to have you in studio. Thanks so much for joining us. Mark Witten from Kaizen Asset Management.